Okay, let's take a look at this. This company began operations in 2013 and purchased a delivery truck for $40,000, and they're going to depreciate it over 4 years using straight line. So they plan to take $10,000 a year in depreciation. For tax purposes, the deduction, so this is straight line, makers, they're taking 50% of the cost, so 40,000 divided by 2, 20,000. So the difference between that 10 and 20 is a $10,000 temporary difference. Pre-tax accounting income is $320. Let's just write that down. Pre-tax accounting income is $320, which includes interest revenue of $30,000 from municipal bonds. That's a permanent difference, so let's subtract that. So our income that's subject to federal taxation is $290. The $320 minus the temporary difference, the permanent difference. Then we have that $10,000 temporary difference. So our income taxable in the current year is $280. Permanent difference, temporary difference. Notice we don't have to do anything, there's no computation there. It's permanent difference. So we have a deferred tax liability of 40% of the $10,000. So we have a DTL of $4,000. And we have our tax payable, 40% of our current taxable income. And that's 40% of that is $112,000. That's our income tax payable. So now let's fill in the journal entry. We have the information we need. The income tax expense is $116. It's the combined. The deferred tax liability is $4,000. And the amount of the check, the tax payable this year, $112,000. And what is our net income for the year? Well, our net income for the year is the $320 minus the income tax expense, $204,000. So with tax, none of it is terribly difficult. It's just making sure you see the pieces and getting the pieces in the right place.